All right. What's up, everybody? It's your boy Kevin over here. It's been a while since I recorded a video. It's been busy, been up and down. I've been trying to record, but then I've been having issues, and that's why even now you can see I'm just recording my screen. I've been trying to see what's happening with my camera here, but it's not been working. But I'm working on it. But to all the traders out here, all the content creators, I know everybody's got a side hustle, everybody wants to make money online and all that stuff. So, on my side, I'm a content creator, I'm a businessman, and I decided to get into the financial markets just to be able to make the extra cash. Anyway, so today I'm going to do market analysis so that everybody, you guys can see how I do my market analysis from beginning to the end, how I enter my buy positions, how I enter my sell positions, what I use, and how I do it. So if you're interested in something like this, if you're in the Forex market, if you're learning how to trade, if you want to understand how to trade, I guess you're in the right place today because we are going to go through the market and how I have gone through the market since I started trading. But today I'm just going to go through how the market has been behaving from the 22nd of Feb to today, which is the 31st of May 2021, which is also my birthday. So basically just take it as this is my birthday gift to y'all. I charge for this shit, but today I've decided to just do good to the world and give out something free. Okay, great. And for those who would want to learn how I trade and know how I analyze the market, you're free to join my group. I will leave a link on the description so that you can be able to join and we can help analyze the market together because I do it with other people. And all those who also want mentorships, just send me a private message and we can see how you can be able to, teach you guys privately. But for now, this is a free lesson. It's just me having fun and helping other people identify uh, opportunities in the market. And for today, we are going to use NASDAQ 100 from the 21st of Feb to the 31st of May. Let's see what opportunities were there. Okay, great. So for me, the way I analyze the market, I do very simple thing. There's something called market structure. Market structure is when the market creates higher highs, higher lows, when it's on buys, and then when it's on sells, it will create lower highs, lower lows as it keeps going. So that is how the market creates a trend. Great. So this is how it happens. The market starts from the bottom, it goes up, it will retrace, goes up, retrace, goes up, retrace, go up. So with this, you already know you're on an uptrend. So when the market is on an uptrend, you get to look for buy opportunities. And for buy opportunities, you are only going to find opportunities when the market retraces, because you don't want to buy the market when the market is here, it retraces that much, and then you get out of the trade too early, you've lost your money, and then the market keeps going up. So you have to know when the market is on an uptrend or when the market is on a downtrend so that you can be able to take your opportunities better than any other trader. Great. So market structure helps us identify what has happened in the market and when we need to execute. When the market breaks a certain structure, we already know this is a structure, this is a structure, this is a structure. So normally when you're looking for a buy, you wait for a structure to be broken so that you can be able to identify, okay, cool, the structure has already been broken, we are in a buy. We wait for the retracement and we enter. We use our tools. A lot of people use different tools. My only tool that I always use is called the Fibonacci retracement tool. It's there, it's free on all your platforms. Nobody should tell you that you have to buy it or purchase it. I'll place my tool, wait for my retracement, and then place my entry. Once I place my entry at a demand level, I wait for the market to go up to my profit levels, normally I would use 0%, where the market came from. My take profit tool is always 27%. If I want to hold on for longer, I would go for 41 or 61%. And that is only for when I'm swing trading. Great. So whenever the market is going down or there's a sell or it's a bearish market, I would always do the same trick when I'm selling, which is a bearish market means the sellers are strong, which means it's a seller's market. A bullish market, buyers are strong, so we are buying. So you have to know when the market is a seller's market or it's a bullish market to make it easier for you to know exactly what you need to do whenever you open a trade or whenever you open your charts. Great. So all these things I can always be able to explain further in detail to all the people who want to learn privately or who want to know, okay, cool, how do I enter the market? What do I do when this happens? How do I identify a demand zone? Okay, cool. We're still going to identify that during this video, but I'm also just going to make sure that I go through it faster because this is more than 6 years of knowledge that I've acquired, and it wouldn't be easy to just offload all the information in one video. So I'll do more videos. If you all want to watch them, you can watch them after this if you want to. Those people who want to get to learn more, just send me a message or just use the link on my description to join my group where I have a free group that I teach everybody else how to trade. And also for those who are also looking for a broker, I've got a link to my preferred broker below in the description. So if you're looking for a reliable broker who's verified and trustworthy, you can use my link to open an account with them. Great. So I'm going to delete that so that we can start analyzing the market. Great. So as you can see here, I'm just going to start. This is on a weekly chart. On a weekly chart, you can see we are currently on an uptrend. The reason why we are on an uptrend is because you can just see the market has just come down from this demand zone. You see it came back to the demand zone and it went up. So demand zones are very important when you're buying, and supply zones are very important when you're selling. Okay? And today I'm going to teach you guys how to identify supply zones and demand zones to make it easier. And we are going to use this period over here between the 22nd to the 31st of May. It's about less than a month. That is okay. We will see how it works out. So we're going to start by identifying demand and supply areas in the market. So as we have seen, number one, we've already identified this demand zone. So what normally happens when you're looking for zones? When you're trading, you always have to start with a higher time frame. Higher time frames. Then you analyze the market on the higher time frames, identify the demand zone, identify the supply zones. Once you're done, go down to the lower time frames to narrow it down even further. Once you've narrowed it down, it makes it easier for you to identify, okay, cool. On this zone, we had a demand zone on the daily chart, on the weekly chart. You go down to the daily chart, you find the same demand zone on that place. What happened there? Identify it, narrow it down even further. Go down to the 4-hour chart, narrow it down. Go to the 1-hour chart, narrow it down. Makes it easier for you to find an entry because you don't want to get into the market on a higher time frame and then there's still going to be retracement. These retracements are happening in the lower time frames. So it's better to get a sniper entry from the lower time frames. In that case, your risk to reward ratio is better than what you would have gotten from a higher time frame. So for me, what I normally do, I analyze my chart on the 4-hour, on the daily chart for the indices. I narrow it down to the 4-hour chart. I use the 1-hour chart for entries, or I would go down even to the 15-hour chart if I need to get 15-minute chart if I need to get my snapper entries. So, like I said, daily chart analysis, check it on the 4-hour chart, use the 1-hour chart for entries. That's if you're trading your currency pair. If you're trading your indices, which is NASDAQ, US 500, US 30, then it's better to analyze on the 4-hour chart, check it down on the 1-hour chart, and then make your entries on the 15-minute chart. As simple as that. Great. Cool. So now we are going to start. Let me just move this down here because we're about to open the market. So the market, at this point, it has given us this demand zone. For the demand zone, I would draw it from week to week, but still, remember, it's now giving us a very big zone, so you don't know exactly where the zone, where the entry is going to be. So what you would do, go down to the daily chart. On the daily chart, you identify, okay, why did the market bounce off this zone to go up? So what you do, you identify, you can see there's another demand zone here. How to identify a demand zone is using the candlestick patterns. The candlestick patterns, engulfing, bullish engulfing candles, that's for when you're looking for buys. Bearish engulfing candles when you're looking for sells. There's the doji, there's a butterfly doji, gravestone doji. These candlestick patterns help us a lot whenever we are identifying entries in the market. And as you can see here, the market came down, and to identify if it's a strong demand zone is when you have a big move that happens after a pause in the market. As you can see, we had a big move, and to be able to confirm that, normally I use 3 strong candles that leave a certain zone. I count them so that I already know, okay, cool, we have this strong move, 1, 2, we have a third one. So we have 3 green candles that left this area. So it makes it easier for me to identify this zone here as a demand zone. And because we know it's a demand zone, on that daily chart, I would make it blue. So what I would do is, at this point, the market is here. We don't know what's going to happen on the other side. So I would just stretch it. I wait for the market to play itself out. And the more the market plays itself out, I keep stretching it because I know that this zone is where my demand zone is. When the market comes back there, I already know this is my zone. I'm making my entry. I'm going in. But then again, you don't know where your entry is going to be. Go down to the 4-hour chart. Narrow it down, guys. Narrow it down. Find again the same zone. You see, it's this zone again. All you have to do is come down, draw your zone there, because that is your demand zone. All you have to do is stretch it out, because you've got an engulfing bullish candle there, which means that came out. You still do the same thing here, because remember, like I told you, you find where the market has left there with a strong move. So you count candle number 1, candlestick number 2, candlestick number 3, which shows you that this is a strong demand zone. Okay, so what I will do is I will put myself, what I will always do, I put a line there over the candle, because I'm trying to identify this zone so that I can be very accurate over the week. So because I've already identified that, normally what I would do, I would put buy limits this zone. So with the other, on your MT4, when you right click, there's always buy limits that you can always put. Buy limits, you put your stop loss and your take profit. And then when the market comes there, it picks up your limit and you're in profit. Comes back down. Let me just draw that. So the market has left. It's ranging, comes back down to where you had your buy limit, picks it up, you're back in profit. And for you to be able to identify it, the best other way, if you do not want to use buy limits, you wait for a candlestick pattern. Like in this case, we have this bullish engulfing candlestick pattern that happened here, right? So you wait for the market to get there, you wait for the pattern to play out, you wait for the bullish engulfing candlestick pattern to play out. Once the candle closes, you enter, place your entry, and then place your stop loss. So you can put your stop loss right at the bottom from where it came. Normally I would go for 3-to-1 ratio, and sometimes depending on the risk, I would go for wherever risk I want to go. So this one, if you go for 3-to-1, see, it's still running. But remember, at the end of the day, you don't want to be greedy. Put your stop loss right down here so that whenever the market comes back down, it doesn't hit your stop loss. As you can see, the market came back down and still went back up. It never hit our stop loss, as you can see. It didn't hit our stop loss. But if you're scared and if you don't know how it's going to work out, whenever you're in profit, just make sure you move your stop loss in profit, or you move your stop loss to entry, so that you're running a risk-free trade, so that whatever happens, if the market goes against you, you do not lose your money. The point of this thing is to trade and not be able to lose your money. We're not here to lose money or donate money to the brokers, right? Great. So at this stage, we're still in the 4-hour chart. Remember, we're still going down lower to narrow it down, to narrow down our entry. So go down to the 1-hour chart, if in case you still haven't entered. And remember, like I said, guys, the reason why we go down to the lower time frames is because we want to make sure we narrow down our entries and make sure we do those sniper entries that will be able to save our lives. So we still have that. We already identified that's our entry zones. If you want to make a sniper entries, remember in the previous entry on the 4-hour chart, we entered somewhere here. We had a retracement. Imagine if you enter your trade on the 1-hour chart. So it means that you're going to wait for the P. This is a doji and bullish engulfing candles. If you're on the 1-hour chart, this would have been your entry point. Or if you're scared and you want to see a bigger confirmation, you wait for this engulfing bullish candle that would engulf the previous candles, then you would enter your trade here. Compared to the other trade, when you make your entry there, last time we entered here, you can see the difference. So it's very important to go down to the lower time frames so that you can be able to make a sniper entry. Because if you had made an entry here, that was going to be your risk to reward ratio, right? You see how big of a margin that was going to be? But imagine if you entered here, your risk to reward ratio goes up. So like I said, if you're going for 3-to-1 risk reward ratio, that was it. So if you had gone for 3-to-1 risk reward ratio, you're still going to hit your profit targets as planned. And like I said, if once you are already in profit, you can just move your stop loss in profit so that you run a risk-free trade. Great. And the other way to identify other demand zones once the market has already left is quite easy. Like I told you, you identify where the market has moved out quite rapidly. Count the candles. and you enter your trade, or you mark that zone and wait for the market to get back there, then you make your entry. Great. Like right now, at the moment, you can already see we've got a demand zone here. We kind of have a demand zone here, but this one was triggered by the demand zone that was here. So as you can see, the market came back to that zone and left. Market went, came back there, left. So every demand zone, the market will always react to it. Every demand zone, the market will react to it. There's a demand zone here. The market came back to this zone. It reacted to it. I can go back and forth. Every demand zone in the market has been tested. Every demand zone has been tested, and it's so easy to identify these zones because the market repeats whatever it does over and over and over. If you go back to the market, even back into 1980, 1970, 1800s, it does the same shit, guys. The same shit over and over, over and over. So it's easier to identify these zones. Once you've already identified them, it makes it easier for you to make an entry. Great. The other tool that I normally use is the Fibonacci tool. The Fibonacci tool is a very great tool to use whenever you're trading because it helps you identify where your retracement levels are going to be and how you are going to enter the market. In most of the cases, I go for 61.8 or the 50 zone. 61.8 or 50 zone, as you have seen. Let me just delete all that and then start afresh. Let's say the market left at this zone. So you draw your feed from the bottom, from the lowest part of the market to the highest point of the market at that time of your trade. As you can see, the market came down to our 61.8 zone. But remember, there was a demand zone here. This demand zone, the market kept reacting to it. But then what happened after it hit that zone? It went all the way up to our profit targets. My profit targets normally is 3, but I use 4 to be sure. I always use the 0% level. When the market gets back there, I would take some of my profits. Or 27% level. When the market gets there, I would also take some of my profits. I would use 41.4 level to also take some of my profits, but my ultimate target is always negative 61.8. So I have profit target 1, target 2, target 3, target 4. So that's what I would go for. Great, are we together? And you can see with this zone, as soon as the market hits this zone between the 50 and the 61, we left the zone and that was it. I call this zone the golden zone. Okay, so when the market is in the golden zone, great, I always jump onto it, take my trades and leave. But remember, as the market is going up, it keeps leaving traces of demand areas. I'm going to give you guys a great example of a demand area that it left. As you can see, the market left here, wherever, it was ranging. And then what happened here? It created a demand zone. And as I said earlier, for you to be able to identify this demand zone, just count 1, 2, 3 bullish candles. The market left here, like big moves that happens from a demand area. So what do? We draw our demand zone. I stretch it out all the way to the other side of the market so that I wait. When the market comes back down to this zone, we are buying. Right, let's see what happens. See what happens? It came back straight into our zone. What do we do when you see that? You place your entries. Place your entries. Risk to reward ratio. We're using 3 to 1. You can use whatever risk to reward ratio you want to use. 3 to 1 is normally what I would go for to make it easier for me because life is as simple as that. And to show you that this was a very strong zone, you can see the market came back down to that level after it had left to retrace, and it left. So let's see how far it went. You can see where we're still going. Great. Let us see. So now what we are going to do, I'm going to identify the demand areas throughout last month from the 22nd to the 31st of 22nd of May, of May to the 22nd of March to the 31st of May. Sorry about that, guys. I'm just going through these dates in my head. I don't even know. Oh, I already deleted it, but as we had seen, it was from here, 22nd of March to the 31st of May, which was today. So let's see what we can do so that we can identify them. Great. All I'm going to do is just draw the demand zones so that you can be able to identify the zones by yourself. I'm going to use blue. I like blue. So we just identify. We draw it from the top of the week to the bottom of the week. Identify. And some of them you'll see where they, okay, like you see, this demand zone has already been tested. Guys, if you're not seeing any demand zone, you keep it moving. There was one here. You see, came back, it hit there. There was one here. So it came, it reacted, but it was not strong enough, it was broken. Currently, if you want to identify it without knowing what's going on, your feed will always help you identify one. Like you see, there's a demand zone there. So we already know the market, when it comes back to that level, we're definitely looking for some buy opportunities. Let's not complicate this thing, guys. It's the market. It does what it needs to do. It's just us to identify the zones and then make our entries. So all we do is identify these zones. If it's not working out, you move along. If it works out, you take the trade and you move with it. Some of them, just make sure you're not greedy and just make sure that you have applied proper risk management. Risk management is very important in the financial markets, and you need to stick to the rules. If you don't stick to the rules, you will lose money. I'm telling you that because that's just the truth, and that's just how all the other big traders have been able to make money out of the market. Like if I put right now all the buy opportunities on this market, you'll be able to see how this has helped you guys or has helped people make their money from the financial markets. All you have to do is come place your risk to reward ratio and wait for the market to get to your zone, and there you go. Boom, you have made your money. And what else is better than making money? What else is better than making money, guys? Great. I'm just putting the possible entry levels. This was a demand zone, so what we would do, we'll just come here and do our risk to reward ratio and place our market expectations where you expect it to go. Like some of them, it doesn't work 100%, but that's the market because you also have to know, okay, what trend are we on? Are we on an uptrend? Are we on a downtrend? So that you already know, like you see, this one didn't work out, it came down. The reason why it didn't work out is because we were already on a downtrend. And when you're on a downtrend, like I said, on a downtrend, you look for sell opportunities. On an uptrend, you look for buy opportunities. And if you want to know that the market is going to go down, there's the market structure, like I said in the beginning. Once a structure has been broken, all you have to look for is entries towards that direction. This was a structure here. There was a structure here. The market came, it broke it. Once it breaks it, we already know we're still going down. So you find your opportunities within that zone, enter your zone, enter your trade, and then wait for the market to retrace, enter your trade, go down. Once a structure has been broken, I'm going to show you another structure. This structure got broken also. You see what happened? Market came back, went up, down. Cool. This structure got broken. But remember, there's a double top here. The market came, broke it. Okay? But this was being broken because this was a strong demand zone. The market had to come back here so that we can be able to go up. The reason why we were going up was because the structure had already been broken with this double bottom. This was the previous structure. So all this did was to break this structure. This demand zone broke this structure, and once it broke it, what happened? It's still going up. So you also have to know your market structure. You have to know where the market has been broken so that you're not stuck on a trend that is dead. That's not what we are here to do. We are going with the trend, and we are making sure that we're jumping on trends that are already active. You don't want to jump on a trend that is dead and then you get stuck in a market that you did not want to be in. So guys, that is just a snippet of how I tackle my trades, and it will be great for all of you guys to be able to understand this and know how to enter this market. I'll be doing more of these videos going forward. I will go deep into it so that everybody can understand. This is just like a rough overview of how this thing works, but trust me, there is more to this. There's using the Fibonacci, there's using how to do your long position entries, there's how to do your short position entries, which is obviously something like that. How to identify these double bottoms and to know, okay, cool, where do I get my, where do I enter the market at this level? How do I calculate my risk reward ratio? When do I take profit? How do I use my fib to re-enter a trade? Great example. This was a demand zone. Let me show you now. I'm going to show you how to, once the market has left, how do I enter the trade? Because we already discussed on how to identify demand areas. This was a very nice demand zone. So if I wanted to, I would put my fib from the bottom to the top. I catch the continuation pattern on the 38.20 and keep going, catch my pips. If I wanted to enter that trade, all I have to do is just identify my entry, place it where I want it to be, and then get my entries right. Risk reward 3 to 1. Makes it easy, makes it simple, and then you make the money. So guys, I will be doing more of these videos, how to identify these zones, how to enter buys, how to enter sells, when to enter sells, when to enter buys, so that we can be able to all help each other. If you are looking for a broker, I'm going to leave a link in the description. I use AxiTrader. They've been good to me. I never have issues with withdrawals. I never have issues with their charts. So I prefer using them. I like them. So yeah, if you want to if you're still looking for a broker that you'd like to use that's reliable, you can use the link in my description so that you can be able to also have fun and enjoy trading. Great. I will see you guys in the next video. I'm hoping to fix my camera so that I can be able to show my face on the screens. I tried this now, but it wasn't working. But I'm still going to be able to try my best. The other thing I'll have to do is get a new camera because technology is not working for me now. But yeah, there you go. I will be showing you more entries. And remember, this works in all instruments. Euro USD, all these instruments. USDZAR, USD NXN, gold, GBP USD, Euro CAD. Identifying demand levels is the same. It's the same pattern that you would use to be able to identify these levels. So it's not rocket science. It just needs patience, guys. Patience. Patience is very, very important. And patience pays. Patience pays. That was a nice demand zone on the gold. This was also a nice demand area on the gold. This was a nice retracement level on the gold. It retraced back to the 50 and went back up from that level. That was a nice one. So using these tools will basically help you identify these zones and identify these levels so that you do not make a mistake whenever you are entering the market. You can even go down to the NZD franc. From immediately you are seeing zones, demand zones that work, demand zones that work. This was a nice demand zone. The market came back to that level. What happened? It dropped. This is a very nice demand zone. What happens when the market came back there? It dropped. And guess what? It came back, it retraced back to 78.6 level. What happened when it came back there? It dropped. And why did it come back? Did it drop? Because this structure had already been broken downwards, which means we were now officially on a downtrend. It's very important to know when a structure has been broken. This demand zone broke this structure, as you can see here. It even broke that structure. So you can see it's broken these two levels just from this one demand, which means that this is a strong demand area. No, sorry, supply area. With your fib level, you enter, you sell. And the reason why we were looking for a sell was because this structure had not been broken. If, let's say, these had broken the structure, then all we were going to be looking for was buy opportunities. But because the structure has not been broken yet, it means that we are still on a downtrend. We are still on a downtrend, guys. Okay, great. All right, my battery is low. I'm just going to stop it here. I hope I helped guys who are still learning how to trade, and I've made it simpler for you. Send me a message if you want to learn how to trade and how to enter these trades, and I will be able to help you enter this, get your trade and your entries perfect. You can see this zone is a very interesting zone. We're looking at the market continuing to go up. Why? Because this structures has been broken. I'm going to just draw. This structure was broken by this demand zone. This structure was also broken. This structure has also been broken. And remember the one I showed you, this one? It finally got broken by this. So now we know we are on an uptrend. What do you do? So because this demand zone has broken 1, 2, 3, 4 structures, we know it's a strong demand zone. We're looking for a continuation in pattern. Draw your fib, find the interesting level, and remember, it just doesn't turn at that level. It means that that's a very interesting area, demand zone, as you can see from here. So it makes it easier for you to identify these zones. Great. All right, guys, it was great making this video for you guys so that you guys can be able to understand what goes on in the market. And that is my cue to leave. It will be great to leave a like, subscribe, so that you can be able to get the next videos that come in, so that I can be able to make more for you guys. And today, being a bank holiday in America, the market is going to move a little bit slower. So I am not trading, I am not touching the market, I'm literally just relaxing, and that's how I decided, let me do this video to help some of the people who would want to understand. My trading style is supply and demand method, and that's how I trade. That's the method I use to trade. And if you want to learn this method, send me a message or join the group, and I'll be able to help you guys even further. Thank you and have a beautiful Monday. From your boy Kev, peace.